Excuse me, losing my voice. I'm going to talk to you very briefly about adjusted trial balance. So now that we've done all the adjusting entries, right? We journalized all the adjusting entries, right? Now what we do is the adjusted trial balance and the financial statement. And here's the awesome thing about the adjusted trial balance. You do it exactly like you do the regular trial balance before the adjusting entries. It just has a different title, and the title is adjusted trial balance versus when we originally did it, it was trial balance. So it's done exactly the same way. So I'm not going to go over doing that again because it's exactly the same except for the title. Okay, so it's all of the accounts. Let me show you a picture here. It just shows you what they're showing you here. This is in our book too, is that all the accounts that are in red were impacted by the adjusting entries. So that means those numbers changed as a result of the adjusting entries. And so in the real world, when you do your financial statements, you would actually prepare your financial statements from the adjusted trial balance. So you would take the information from this adjusted trial balance, and then you would create the income statement, the retained earnings statement, and the balance sheet. And that's where we started in the beginning, remember? So now we're starting to work our way through, starting to see, like if we look on here and we see like this prepaid insurance 550, right? Now we're starting to learn a little bit about where these numbers are coming from. In the beginning of the class, I talked about how we're going to start with the great big car, right? We're not going to look at all the parts. Well, now we're going to start diving into all the parts. So all the chapters from this chapter forward are going to be getting into all the details of where these numbers come from. Okay, so I'm not going to go into this. Okay, now we are going to talk about a brand new concept. And this concept I talked about briefly in the beginning lecture of this chapter, and this is called closing the books. So if you were to look at an accounting job online and you were to read like the advertisement or something, it might say something like month-end close and year-end close. So month-end close is what we just did. Month-end close is doing the adjusting entries and preparing the financial statements. A year-end close is where you are actually going to close out accounts, okay? Now you have to bear with me for a moment on this one because this is like a kind of a really different concept. And so I'm going to explain things and kind of give you some examples to help you to kind of remember some of the information for this. You will do this in this chapter and we will never do it again in this class, okay? Later on down the line, and you get a business degree, it could come up, and if you go to work for a company and you do accounting, it will come up again. So we are now in the last steps, which is closing entries and then the post-closing trial balance. And the post-closing trial balance, again, is done just like the original trial balance in the same order and everything. You're just going to have different totals after the closing. So first I'm going to tell you this, and then I'm going to kind of explain it a little bit. All right. So at the end of the year, you are going to close out the temporary accounts. And these are the temporary accounts. Okay, so you will want to make a note of this. The temporary accounts are all revenue accounts, all expense accounts, and all dividends. So the temporary accounts that you will be closing out are the revenue accounts, the expense accounts, and the dividend accounts. The permanent accounts that you never close out are the assets, the liabilities, and the stockholders' equity. Now, let's talk about the temporary accounts first. So a temporary account is an account that you're only tracking the numbers for a year. And the reason why you're only tracking them for a year is because after a year, I mean, if you never canceled out these accounts, the number would just not make sense anymore. It just wouldn't be of value. So I'll give you an example of this. Let's say that you have a company and you pay $55,000 in salaries every year to your employees, $55,000. So at the end of the year, your salaries and wage expense would show $55,000, right? Well, let's say that you never closed your books. You never closed your books at the end of the year. And now we're in year 7. You would look at your financial statements and it would show that salaries and wages expense is $385,000. So that's a number that represents how much salaries and wages you paid for 7 years. but it's really not a number that you use. It's not a number of value. You don't use that in like your budgeting or things like that. Now, if you were doing a 5-year plan and you wanted to know like what you paid over 5 years, you would just add up to the end of the year for 5 years. It takes like a minute to do that. So what happens is that the number starts to not make much sense. So I'm going to give you another example. The company that I went to work for in 1992 had been in business for 72 years at that point. 72 years, right? So let's just pretend they paid $75,000 a year in salaries, right? Times 72 years if they never closed their books. That would be $5,400,000. That's what their total salaries and wages expense would show. It just, the number becomes useless, okay? Same thing is true with the revenues. Let's say that you made $120 a year in revenues, okay? The end of your first year, you go, okay, 120, I'm gonna set my goal next year for at least 120, right? Well, let's say that you made that same amount for 15 years. Well, at the end of 15 years, it would show you made $1,800 in 15 years. But again, it doesn't really have value. You look at things for a month, a quarter, and a year. That's what you really look at from an accounting standpoint, okay? Same thing with dividends. So those are temporary accounts. We zero them out at the end of the year. So that means at the end of the year, when we start the new year, salaries and wage expense will start at a zero balance because we have had no expenses in salaries and wages on day one of the new year, okay? Now the T account will still show all the transactions that we had, and it'll show the balance at the end of the year, but then it'll show the zeroing out, and then it'll show the start of the new year to zero, okay? Now the permanent accounts are never zeroed out, and I'll give you 2 personal examples of why these are kind of to help you remember why these are never zeroed out. Let's talk about assets first. Okay, let's say it's New Year's Eve. You're going to a big party, you're going to the city, you're going to go to a party. Before you go to the party, you open up your phone and you check your bank account. You're like, oh, okay, I got $125,000 in my bank account. Wouldn't that be nice? I'd like that. You go, okay, I got $125,000 in my bank account, cool. Going out to a party for New Year's Eve. Not going to spend that, but I know I got $125,000. You go out, you go to the party, New Year's Eve. You wake up on January 1, you're making breakfast, you open up your account, and you look at your bank account and you have no money. You have zero. That's what would happen if they zeroed out your bank account. Would you be upset? Oh, heck yeah, you'd be upset, right? It'd be like, where's my money, right? So you never zero out the asset accounts. That money is a representation of the assets you have on hand. Now, your cash account can go up and down, and it goes up and down based on you spending money or giving money, right? So assets fluctuate based on that. They're never zeroed out. The same thing, if you had a car and a house, that would be like you woke up on January 1 and your car and your house are gone, okay? Liabilities. Now this part we might like. New Year's Eve, you're going to a party, you're going to the city, getting all ready. You look online and you're like, oh yeah, I have that great car, but I owe 25 grand on that car. That's my loan, which if you owe 25 grand on a car, you need to take the personal finance class. So you owe 25 grand on the car. You're like, yeah, okay. You go to the party, have a great time, wake up the next day, you're eating breakfast. You look online on your phone, and you're like, oh, wow. My $25,000 loan now has a zero balance. That would be totally awesome. That'd be totally awesome because you wouldn't owe the money anymore, right? Well, unfortunately, we don't zero out liabilities either. The way liabilities come and go is that we buy things on credit or we pay things off, okay? Same thing with stockholders' equity. Your stockholders would not be happy if on January 1, they woke up and all of the stock they owned in your company was gone. Or if you were a stockholder of a company and you owned like $10,000 of stock in a company and you woke up on January 1 and you no longer own that stock. So temporary accounts are zeroed out. Permanent accounts are never, ever zeroed out, okay? You never, ever zero out a permanent account. You only zero out the temporary accounts, okay? So let's go and look at what the process is for this. We're going to look at a sample, and this is not very hard to do. This is like a memorization of accounts and process, and you're going to do it this one time, and that's it. All right. So the purpose of the closing entries is to zero out those accounts, right? And then we're going to transfer over the difference between what came in and what went out over to actually show it as our earnings. So we do this by running through an account, which is a new account that you've never seen before, called Income Summary. And you will want to make a note of this. Income Summary starts at 0 and ends at 0. Starts at 0, ends at 0. Income Summary. It starts at 0, it ends at 0. And that's going to be an important kind of check for you. Okay, and I'll show you what that means. So the other thing to remember is that the revenues and expenses are going to run through Income Summary, and the difference between the two will go to retained earnings. But dividends runs directly through retained earnings. Okay, and I'm going to show you all of this, so don't panic. I'm just kind of giving you more information about it right now. Okay. All right, so let's look at this. Okay. So this is an example of the steps, and this is the order that you do the steps, okay? So the first step you're going to do is you are going to do the revenues. The second step you're going to do is the expenses. The third step you're going to do is the retained earnings, and that's going to be the difference between the revenues and the expenses. And the last step you're going to do is going to be the dividends, all right? So let's look at each one. First step, revenues. Now, this goes back to chapter 3. How do you get rid of a balance in an account? Well, if the account is a debit balance, in order to get rid of it, you have to credit it. If the account is a credit balance, in order to get rid of it, you have to debit it. So you do the opposite of what the normal balance is. So let's look at the first one. So step 1 is always the revenues. So we have here the service revenue is $10,600. So in order to get rid of the service revenue, we are going to debit service revenue $10,600. And then we're running it through the income summary account. So we're going to credit income summary $10,600. Okay. Step 2, and we're going to do a sample problem together. Step 2, in order to get rid of an expense, expenses have a debit balance. So to get rid of the expenses, we have to credit them. So that means that we have to debit income summary. So this will be the one time that I'll tell you, put the account title and do not put the total for income summary yet, because you have to total up all of your expenses to figure out what you have to debit to income summary. Okay. So you would go through and list all your expenses. So we got salaries and wages, 5,200, advertising, 1,500, rent expense, 900, insurance expense, 50, interest expense, 50, and depreciation expense, 50. Now, if we total all of those up, they come to 77,400. So that's where we then would debit income summary 7740. Sorry, not 400, 7740. Okay, next step is we are going to recognize the retained earnings. And the retained earnings is the difference between what came in, 1060, and what went out, or 10600, and what went out, 7740. So if we take 1060 minus 7740, the difference is 2860. That's how much we earned. So we are going to debit income summary 2860 to clear that out, and I'm going to show you why we're debiting income summary in a minute. And we're going to credit retained earnings 2860 because we want the retained earnings to go up. Now, the way you know that it is the way we know that you are doing a debit to income summary is that you have to look at the difference between the entries that you started with and the entries you ended with, right? So if we do just a little T account on here, I'm just going to do a little T account really short here, and I'm going to real quick here, I'm going to show income summary, right? So income summary starts at 0 and ends at 0, right? So the beginning balance was 0. We're just going to look at the entries here. So we're going to credit income summary 10,600, right? 10,000. Oh, this is hard to do on here. 600. It's sloppy, but there we go. 10,600. Okay. Then we see here we're going to credit, or we're going to debit income summary 7740. So 77.40, we're going to debit it, right? Look how sloppy that is. Wow. Okay, 77.40. All right. Okay, so now if we balance that, that's going to tell us what we have to do next. Okay, so if we always subtract the smaller side from the bigger side, right? So we're going to subtract 77.40 from 10,600. And that's going to give us 28.60, and it's going to be on the credit side, right? So 28.60 is on the credit side, right? So how do we get rid of a credit? We have to debit it. So that is where we come into debiting income summary 28.60. Okay. Now, what I suggest you do to help you is that little piece that I just did, this whole little T account, that you do that on scratch paper. That would be something to help you to kind of remember what you're supposed to do if you debit or credit for income summary. Now, if it was a net loss, you would be crediting income summary. But again, in this class, you're not going to see a net loss. You're only going to see a net income. Okay. So that's just kind of an example of showing you that. And then we will do a sample problem together as well.